Hello and welcome to our conversation on the preparation of financial statements or examining the impact of business decisions on the financial statements. In this series, we will try to understand a one particular business decision, that is a stock repurchase or buyback of shares effect on the financial statements. Before we get into the exercise, let me give you a broad understanding about this particular decision, which is the buyback of shares or stock repurchase. Buyback of shares or stock repurchase is a very common and a popular business decisions taken by companies all over the world. However, the way the buyback or stock repurchase is treated in the books differs from country to country. In this exercise, I would like to show and explain the generic principles of the impact of buyback on the financial statements. So therefore, it is possible that the way the buyback is treated in India may not be same as the way it's treated in UK or US or Singapore or China, but the broad principles which govern the buyback of shares or the stock repurchase will be more or less same. So with this backdrop, let us go to the information given. So for us, let us take an existing balance sheet, and here we are not getting into any other transactions. No incomes, no expenses. We're just trying to understand the impact of the buyback on the financial statements. Suppose on this date, or the end of the 2017, the balance sheet is given. The number of shares of the company is 400,000 divided by the face value, so 40,000. Equity of the company is equal to 400,000 plus 600,000, so therefore 1 million, and the book value per share is 25. So face value is 10, book value is 25. We don't know the market price. Market price is decided by the market, which depends on the demand and supply. Suppose on this date, the company decides to buy back or make a stock repurchase of 20% of its shares. So number of shares available is 40,000, and shares bought back is 20%, so the number of shares bought back is 8,000. So that means the company A, let us make it this of A. So company A is buying back this 8,000 shares from the market, from the existing shareholders at a price of 25. Observe, I've given this price which is equal to the book value per share. It can be anything. The price can be very high, very low. That depends on the many other things about the pricing. So if the price is 225, so the cash payable by the company is 200,000, assuming that all 8,000 shares are bought back. But what is this 200,000 consists of? The 200,000 is 8,000 into 10, which is the face value of the shares, and 8,000 into 15, which is the premium. Premium is 25 minus the face value, is equal to 120. So this is the information given. There is a buyback of 20%. So let us examine what happens at that point of buyback. At the time of the buyback, the cash is reducing to the extent of cash is reducing to the extent of the money paid, and the money paid is 500,000, money paid is 200,000, and the company's cash will reduce to the extent of 200,000. There is a payment. And how much is this payment? Payment is 200,000. Now, normally, in most of the countries, whenever the company makes a stock repurchase, immediately they are shown as a treasury stock. So therefore, the treasury stock is, I'll remove the word less, I'll explain that a bit later. The treasury stock is shown on the balance sheet as minus 20,000. Because the treasury stock, the shares bought back, is considered to be a capital reduction, is considered as a negative equity. Instead of immediately reducing the capital, the buyback of shares or shares bought back is shown as a treasury stock in most of the cases. Okay? So capital continues to be the same amount, but the treasury stock is shown as a negative equity. No change in the retained profit because nothing has affected the retained profit as of now. No change in the bonds. No change in the bonds. So the total sources is 110,000 because capital has been bought back. But you can ask a question, why it has not been reduced? Because at this time, this is at the point of buying back the shares. The company can decide to hold it, the shares purchase, or can cancel it. So in most of the countries, the shares bought back, the company can hold that as the treasury shares. So therefore, the balance sheet would look like this. So let us recap. This is at the time of the buyback. The shares bought back, instead of reducing it from the capital, they are shown on the balance sheet as a treasury stock. And the value of this treasury stock is the money paid to buy those shares. And cash has reduced because there is a cash outflow. But let us understand the impact of this. At this point, what is the number of shares available in the market? The number of shares available in the market, which is also called outstanding shares outstanding, is 40,000 minus the shares bought back. The shares bought back is 8,000. That means this 8,000 shares which the company has purchased are not available for trading anymore. They are with the company. What is the equity of the company? The equity of the company is equal to the capital plus retained profit minus the treasury stock. Because treasury stock is considered as a negative equity. Because in principle, the company has already purchased. Those shares are not there in the market. The book value, what is your guess? Book value will remain same because the price at which I purchase is equal to the book value. That is why. So whenever there is a treasury stock, which is the shares bought back, normally it is shown as a negative equity. So if you open the annual report of an US company or any other country's companies, you will see that there will be a treasury stock if the company did some stock repurchase. That means the company has purchased the share, till now have not yet decided what to do with those shares. So that is a possibility. But observe this. Whenever there is a repurchase of shares, the transaction affects the cash flow statement and the balance sheet only. There is no effect of the buyback or repurchase on the income statement. This is a generic principle. But let us assume that the company decides to cancel the shares, destroy the shares. In that case, the capital will reduce by 80,000 because the capital is always shown at the face value. So the capital will reduce by 320,000 to 320,000. But the excess money paid is 120. Originally the shares were not issued at share premium. We can see that there is no share premium. So since there is no share premium, the excess money paid can be adjusted against the retained profit or reserves. So the retained profit reduces to the extent of the excess money paid, which is a premium on buyback. Even now it is not shown on the income statement. That means income statement is no way affected by the buyback of shares. What happened to the treasury stock? It is now cancelled, right? Because they are cancelled, so therefore there will be treasury stock will become zero. Okay, the treasury stock will not be there anymore. The treasury stock will become zero because the shares have been, the treasury stock has been sold or cancelled. No change in the bonds because nothing, we have not done anything with the bonds, and there is no change in the sources side, no change in the stock, no further change in the cash. So therefore asset should be equal to. So what will happen if to the book value? Book value of the shares, whether it is cancelled or they are held on the balance sheet as a treasury stock, the book value will be same. Doesn't matter. For a good reader of balance sheet, both are same. To summarize, therefore, whenever a company purchases or repurchases its shares, at this juncture we are not interested in understanding why do companies do that. We are just trying to understand the impact of the buyback on the balance sheet, and that to a generic principle. Whenever there is a buyback or stock repurchase, at the time of purchase, the shares are shown as a treasury stock. But the management can decide to hold it or to cancel it. If they hold, then this will continue. The treasury stock will continue to appear on the balance sheet as a negative equity. But because the shares have been withdrawn from the market, the number of outstanding shares will reduce. These 8,000 shares are now with the company, not available in the market for trading. But if it is cancelled, the capital will be reduced. Any excess money paid will be reduced from the share premium or from the retained profit if there is no share premium. In India, this treasury stock concept is slightly different because we are not allowed to, India is not allowed to hold the shares of its own on the balance sheet. Normally, the shares are cancelled. If it is cancelled, so then the transaction's impact will be like this. Capital reduces, retained profit reduces, share premium reduces, and cash reduces. And few more conditions are there. As I mentioned, at this juncture, I've not discussed about the conditions attached to the buyback. All that we have tried to understood is impact of the buyback on the financial statements. In the next presentation, we'll see if they are not cancelled, but they are once again reissued by the company. Thank you very much.